Don't fear the bear. Most people invest in the stock market for the purpose of growing wealth. So when a down market comes along and stocks are dropping like an elevator, our natural tendency is to want to sell stocks as a means of protection. The fact that market downturns are often characterized by rapid vertical declines and negative media headlines only exacerbates this tendency for us to want to sell. But is selling in these situations usually the right move? History shows that rather than giving in to fear, staying invested and buying stocks during volatile times can be beneficial in the long run. Let's start by looking at volatility. Volatility measures how much the market goes up and down. Low volatility is when the market is smooth sailing, like a sailboat on a quiet lake. High volatility is when the market goes sharply up and down, usually more down, so that it feels like a roller coaster. Most of us don't want to be on a roller coaster or even a sailboat during a big storm. To measure volatility, we use something called the VIX. The VIX calculates the prices of several indices that measure expectations of price moves over the next 30 days. The VIX is nicknamed the Fear Index because it is considered an accurate gauge of investor anxiety. The average VIX level is about 20. A VIX level of 40 or over is considered elevated. To put this in perspective, since I've been a financial advisor since 1997, the VIX has exceeded 40 only 8 times. This Monday, March 9th, the VIX went over 60. That is the second highest reading since 1997. Wow, there is certainly a lot of fear and anxiety out there right now. It's interesting to look at the previous 7 times the VIX broke 40, indicating extreme fear, and observe if there is a trend in subsequent market performance. Here's the chart. I'd like to thank the Hartford for their data. It shows the S&P 500 index returns when the VIX was greater than 40 since 1990. Let's focus on one-year returns. In 1998, after Russia's economic crisis, 1 year later the market was 40% higher. In 2001, after trading resumed for the first time following the September 11th terrorist attacks, 1 year later the market was 15% lower. But note the 5-year number. In 2002, remember the accounting scandals highlighted by bankruptcies at Enron and WorldCom. 1 year later, the market was 23% higher. On September 29, 2008, the U.S. House of Representatives rejected a proposed $700 billion bank bailout plan. 1 year later, the market was 1.5% lower. But remember, this was 2008, and again note the strong 3- and 5-year numbers. In 2010, after the flash crash caused stocks to decline rapidly by 999 points with no apparent reason, 1 year later the market was 23% higher. In 2011, the European debt crisis and the S&P downgrades for the government debt from AAA to AA for the first time in history, 1 year later the market was 28% higher. In 2015, after the China currency devaluation sparked a sell-off, 1 year later the market was 17% higher. And March 10, 2020, after the coronavirus outbreak induced fear-based selling, 1 year later, well, we'll have to wait and see. Looking back, within 3 years of each decline, the market not only reversed its losses, but produced additional positive returns in each case. 5 years out, those gains remained positive. I hope this data makes you feel better about the current market conditions and the market outlook. Another advantage of not giving in to fear-based selling is that no one knows when the market will resume its upward course. Since recoveries are often V-shaped, remaining invested means participating in the recovery as soon as it occurs. If you have questions or concerns about the current market downturn, please call our office in Largo to schedule an appointment. We're not here for the short term, not even until the VIX gets to 40. We're in it for the country mile.